Well, Asya, to look at those issues in a little more depth, I'm joined by Chris Giles, economics editor for the Financial Times. Chris, thanks so much for joining CCTV. The IMF has clearly expressed its view about the US Fed possibly raising interest rates. What is its concern?
Its concern is maybe that the Fed might go too early. It's not saying don't raise interest rates, but it's saying wait for firmer evidence before you press the button to raise interest rates. Both for the US economy as a whole, for the US itself, it's saying you don't want to go too early and then snuff out the recovery that the US already has, but also for the wider world, because it's one of the big concerns about the global economy is that in emerging markets, lots of companies have borrowed in dollars. And if the US raises interest rates, the dollar might rise, and they'll find it harder to pay back those debts, might go bust, and then you have a bit of a crisis in some more fragile emerging market economies.
And moving to another very important economy, China. Now, the IMF has downgraded growth for China, and it's also said that it could pose a risk for the global economy. Why?
I think it's now just simply because China is so large. It used to be the case that if China had a problem, it wouldn't really affect other countries. But now China's really the same size of economy, at least, as America. So if it has a big problem, then it affects Asian economies and perhaps wider economies. And one thing we've seen is that there's been a very sharp slowdown in industrial production in China, and so its buying of iron ore and other metals and oil is much lower than expected. And we see a knock-on effect to commodity prices. So countries that have really concentrated on commodities and irons, of Brazil, Russia, Australia even, are seeing the knock-on effect on their economies of the China slowdown. But we don't really know. The IMF isn't saying that China's going through any crisis. It's saying it's a managed, at the moment it's saying it's a managed transition from investment and heavy industry towards consumption and services. And it's sort of saying keep going along that path and don't do anything, because don't try and stop that transition, because it's a transition that China has to make.
Now, China's, of course, classed as an emerging economy or a developing nation, but developed nations aren't necessarily out of the woods, so they're slightly better off than perhaps emerging economies. But what is the IMF saying about Europe?
Well, for Europe, the IMF is saying that growth is too slow. There's some real stars in Europe at the moment. Spain and Ireland are highlighted as having made some very successful transitions and having good growth, but it's saying that it wants the whole European economy to reform more so it can grow quicker, and it's asking Germany, which has very strong public finances, to spend a bit more money to help that process along.
Okay, and now the IMF has made acted with some caution. It's saying that they're going to have to downgrade global growth as a whole. Is it making any suggestions to stimulate global growth?
Yes, it's saying that countries where they have the room to stimulate, and I just mentioned Germany, it also mentions the Netherlands as well, they should use their public finances if they have that room. It's said for the Fed, maybe it should raise interest rates as quickly. For the European Central Bank and the Bank of Japan, it's suggesting that then maybe they should do more to stimulate their economies. And in emerging markets, it's saying where countries haven't got a particular crisis at the moment, so not the Brazils of the world, but they should keep growth going as fast as they possibly can, because global growth at 3.1% is the slowest for 5 years, as you said, and the IMF thinks the world economy should be growing faster than that, maybe 3.5% to 4%.
Thank you, Chris Giles, economics editor for the Financial Times. Thank you so much for explaining that to us. Back to you in the studio.